All right. Welcome back to another episode of the Real Estate Investing Club. Happy Friday, everybody. As always, it is Friday on the podcast. We're bringing that Friday energy to you. Today is a good day because we have Bill Faeth with us on the podcast. Bill has a lot of experience. You name it, he's done it. But his specialty is short-term rentals and hotels, which I'm super excited to get into because we don't really talk about that a lot on the show. So, Bill, thanks for hopping on.
Yeah, thanks for having me, Gabe. I'm excited to dive in and talk some shop today.
Absolutely. I told you before we get on here, we always like starting with stories. We like to hear how people got to where they are. So why don't you go back to the beginning of your story and tell us how you got here?
Yeah, I mean, I'm 52. I've been an entrepreneur since I was 19. I played professional golf. I've been a college golf coach. I've done 39 startups, exited out of 31. Have built 3 companies over 30 million, one over 50 million. Have done over $1 billion in sales. I've done a lot of shit in my long life, to be honest with you. And there's some very consistent components to the successes and failures that I've had along the way that I've taken and I've applied to real estate. So in 2015, I exited the long-term rental space and jumped in to the short-term rental space. It was interesting. Prior to that, about the last 3-4 years prior to that, I was at our city council meetings in downtown Nashville every single Tuesday, and I saw all these bills. I was battling Uber. So I had the fastest growing ground transportation company in the industry, like limo companies, airport transportation, buses, that type of stuff. And I kept seeing these Airbnb bills that would be coming up for votes and regulation and all that type of stuff. And then one day I'm playing golf at my country club. A guy that's an electrician owned a long-term condo in the same building that I did. And we were playing golf one Friday afternoon. And we just started talking, "Hey, how's it going?" He's like, "Well, I used to get like $2,700 a month, but I started this Airbnb thing and I just did like 7 grand last month." And then a month later, we start talking about it again over a couple of beers. And he's like, "Dude, I just did like 9 grand on my 2-bedroom condo." I'm like, "What the fuck are you talking about?" I'm still sitting back here getting $2,800 a month for a long-term rental. And that's what opened my eyes. That was like probably fall of 2014. Early 2015, I sold every one of my long-term assets. And I started redeploying into short-term rentals at that point, and I started in Gulf Shores, Alabama. And then kind of the race was on to where we're at today. So it's been about a decade.
Wow, interesting. Yeah, I've heard numbers like that. Some friends of mine do short term, and their single house that you would rent out for $2,500. They're making sometimes $10,000 a month, and I'm just like, that is insane. And so
I have 2 houses, Gabe. They are both beachfront houses in the Outer Banks. They are both going to do about $600,000 a year in gross revenue.
that's crazy. And if you think
It's
about
why
those,
I believe that short-term rentals is the number one asset class to invest into that we have. I mean, from a security standpoint, from a cash flow standpoint, obviously, if anybody knows about the short-term rental loophole and what's happening now with 100% depreciation coming back, it's the best tax shelter that we have. It's different than MTR, LTR, commercial or industrial, right? So, I mean, that's why I have gone all in on short-term rentals over the last decade.
yeah. Yeah, there's a lot of opportunity here, but there's also a lot of pitfalls. I have heard, you really do need to be buying smartly, like any other asset. You need to know what you're doing. If you don't buy in the right spot, you're not going to be able to get filled. The regulations that are surrounding the industry. This is all stuff I'm sure you know. So,
But that's the same, that applies to any business. Whether I'm an investor in the Section 8, I'm buying $80,000 properties, whether I'm going to go flip a property today, it applies to everything. And I think that short-term rentals get a bad rap. Now, here's what's happened. There's a bifurcation that's happening in our world today. The rich are getting richer and the middle class is getting they have an opportunity. They either have to rise to the top or they're getting pushed down to the bottom. I'm a firm believer within 5 to 10 years, we will not have a middle class anymore. It sucks. I grew up middle class. I've been middle class the majority of my life. But that same thing's happening in real estate investing. You can't go buy a $400,000 3-2 and make any fucking money in that in
yeah,
short term and mid term and long term. And flipping, you need to be a lower price to be able to, do more ARV in a flip for lower costs. It's that bifurcation that's happening in everything that we're doing in business right now. And I think people need to be very, very aware of that.
yeah. So I'm curious. You're from Nashville. Nashville is one of the best short-term rental cities in terms of like how much money you can get out there.
It could be the
But
worst, actually, right now. It used to be.
Okay.
From about 2013 through 2018, it was the number one market in the country for investing in the short-term rentals. It is no longer. And it's because of regulation. There's two things that I have major concern about for, or really I shouldn't say major, but my biggest concerns for anybody investing into short-term rentals. Number one is regulation, and
Mm,
that's happened here in Nashville. It's very challenging to break into the market. And the biggest problem is we're maxed out at 4 bedrooms.
mm,
Right, 4 bedrooms and 10 occupancy. So there's a gazillion 4 bedrooms, and there's still tons of construction that's happening, and it's all being stacked together inside of Davidson County. So there's no way to become unique. There's no way to stand out, right?
okay.
The second concern for short-term rentals is lack of consistency, guest consistency. I'm a JW Marriott. I'm a Marriott guy. I've been a corporate traveler my entire life. I know exactly what types of pillows are going to be on that bed. I know what's going to be in the bathroom. I know it's going to be clean. I know what cable selections they have. And literally, I select Hilton or Marriott based on knowing what sports I'm probably going to be able to watch or not get on the channel selection. We don't know that about any Airbnbs. So I could come and stay at your place, Gabe, and have an unbelievable experience. Coffee bars, 5, 6 pillows to choose from, amazing design, free t-shirts and towels, whatever. But then you go right next door to condo to my place and it sucks, but it's the same building. It's the same, 2 bedroom layout. But what's different is the way you host and the way that I host.
Yeah.
That's the lack of consistency. And it's not just for corporate travelers like me. I'm on the road. I fly 40, 50 times a year, right? I speak, I host events, all that type of stuff. But it's also about the families, because if you've been in a fight before, physically, mentally, if you've ever been in a relationship, anybody that's listening out there that's ever been cheated on, it's hard to come back from that. And you carry that baggage forward with you. So when somebody has a bad experience at a restaurant,
Mm.
at a coffee shop, at a hotel, or at an Airbnb, they carry that forward with them. And I think that's honestly the biggest concern that I have with our industry.
Yeah, people are having a lot of negative experiences. I've actually stayed at Airbnbs. I've stayed at great ones, and I was like, "Wow, this is amazing. This is a great deal." And then I've also stayed at ones where I'm like, "This is literally somebody's back room. It's there's nothing here, and I'm paying $200 a night for it." So that makes a lot of sense to me. You started investing in Alabama, which is interesting since you were in Nashville. Why did you choose to go outside of Nashville? And Alabama is kind of one of the wouldn't say lower tier states, but it's not some place that I would expect you to start for short term rentals. Why'd you choose
I
Alabama?
avoided Nashville because of the regulation.
Okay.
I mean, it's so the political struggle in Nashville, Tennessee with the state. The state is a very red state, one of the reddest states in the country, but the city of Nashville, Davidson County, is the
Mm,
bluest, right? So they
mm,
battle back and forth all the time. And it's just, I don't invest, I'm not going to get political here, but I do not invest in the blue states at all. I left California 23 years ago, not because I'm about as straight line, just for your listeners, as it comes politically, right? I vote on both sides of the
yeah.
fence, but I vote with consistency and I vote with my wallet as a business owner. So the best places to invest into real estate as a whole is in the southeast of the United States. Lower cost to entry, right? I can get and it's what you say about Alabama is 100% true. But there's also that's not the market. The market is Gulf Shores, Alabama, right? And even when people think about Gulf Shores, they think, "Oh, Orange Beach, Gulf Shores, Fort Morgan." Those are then the sub-markets. So I'll just give an example. Back when I started in 15, 16, everybody was investing into like Destin and the Smokies and stuff, and it was dirt cheap. But literally the first house I bought was a tier 2 beach house in Fort Morgan, Alabama, not even in Gulf Shores. Paid like 620,000 for a 4 bedroom, 4 bath, and had unbelievable views of the ocean. I picked that up and I dropped that into Destin. 10 years ago, that property was $1 million,
Mm,
right? So I look at lower entry costs, but where can I also do the same amount of revenue generation without having to pay that premium? So I invest in the secondary and tertiary markets all over the country. Instead of going to the Smokies, I went to Banner Elk, North Carolina. Instead of going to Big Sky, Montana, I went to Whitefish, Montana. Instead of going to Scottsdale, Arizona, I go to Cave Creek, right? Instead of Lake Martin in Alabama, I go to Smith Lake. I go to all these different markets, the Outer Banks. I'm only in one 3 mile area. It all surrounds Duck, North Carolina. I don't go to Nags Head. I don't go to any other places. My first hotel, I didn't buy it in Louisiana. It's not in Baton Rouge. It's a fucking block off the French Quarter in the prime location. Does that make sense?
Yeah.
So all of those factors play into making a sound investment also in that bifurcation that's happening.
Okay. So let's actually dive into that real quick. Let's talk about your underwriting criteria. When you're looking at these properties, what are the first three things you look at? You know, the bed bath ratio, location. You've already mentioned you look in tertiary markets. What are the primary things you're looking at when you're picking out short-term rentals?
90 seconds. What is my hero image going to look like on my Airbnb listing? What's my first post on Instagram? What am I going to show my wife the first image of? What is going into my Facebook ad? Whatever I'm going to do, it's marketing, right?
Okay.
And
Oh, you run
if I
Facebook
can't
ads
see
for your Airbnbs.
what's that?
You run Facebook ads for your Airbnbs.
1,000%.
Really
That's
interesting.
why I outperform the top 1% by 52%.
Interesting.
So
I
I do. Go
how
ahead.
do you so I don't want to geek out about this too much, but I love running ads. It's one of my favorite things to like do with my properties. So but short-term rentals, it's such a small. I mean, you could be servicing somebody who's flying from across the country. How do you do the targeting for those ads?
So I start with the top 5 markets that the guests are driving in from. So I'll use Gulf Shores as an example since we were talking about that, right? That's Dallas, Texas, St. Louis, Chicago, Indianapolis, and Nashville. So I will go in and I will run $1 to $3 a day into those markets, usually $3 a day, and I'll have 3 ads running. One will be a primary ad, and the second will be retargeting ads to go behind them.
Nice.
And I'll let those run for 14 days. Then I implement my buy sell trade group strategy where I go into Dallas and I'm in Highland Park, Midtown, all the
Mm,
wealthy areas
yep.
because I'm trying to attract wealthy Wendy, my buyer persona,
Yeah.
as my customer, my guest. And it doesn't matter if it's one of my $3 million super properties or a $395,000 condo that I own. I'm always going after that same buyer, right? So I run the Facebook ad. So you think about it. Everybody gets scared. Oh my God, they're expensive. They're so hard. They're not fucking hard at all. And at $3 a day for 2 weeks, we're talking, what is that? $37 in ads. That's it.
Yeah.
But then I come
Yeah, I
back
love
in
Facebook
and
ads.
I'm a member of probably 10 to 20 or 30 of the top tiered buy sell trade groups in those markets, right? And I'm not talking marketplace and I'm not talking all the way to Frisco, Texas. Just I want to hone in on the wealthy parts of that town. And then I just do a rotation from Dallas. I'll run the ads for 14 days and then I'll post in the buy sell trade group and let that ad run for about 5 more days to support the buy sell trade group. So hopefully I get some type of subliminal view or reach to people that are in these groups. And then I hit them with what I call the emoji stacking post. And it's literally all my amenities, fire pit, coffee bar, blah, 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 blah. And I put in my top 10 images. And then the third part is literally I've got a book coming out. It's about the 2 extra steps. I've made my millions of dollars off doing stuff that lazy people won't do, right? So I one, most people won't go and spend the time to research and find the right buy sell trade groups. 2, they'll just go in and post everything in marketplace because it's easy. 3, if they do post in buy sell trade groups, they're not ready to reply and personalize it.
Mm,
I'm the guy that has the template ready to go. But when Gabe says how much, the ridiculous thing that everybody says, I've got it all written and out. It's all personalized. I'll copy, I'll paste, and I will take the extra 3 seconds to say, hi, Gabe. Thank you for checking out my post. Does that make sense? And then
yep.
I'll give them the information that's already pre-canned, ready to go.
Nice.
So it's that
With
it's an
AI chatbots
omni-channel
now,
marketing strategy that works between both of these channels, but on both of the delivery channels, but on the same platform. Does
yeah.
that make sense?
Hmm.
It's gold. I've been doing this for 5.5 years. Now you got to remember, I've deployed over $16 million of ads in my lifetime. I built HubSpot's partner agency program in conjunction with Brian and Dharmesh, the founders of HubSpot. I've used marketing and sales for all of my companies, and that's the separator for me. And what I teach my 33,000 students is how to be different, how to stand out from the crowd without having to spend boatloads of money on real estate and design and these stupid, crazy amenities and $100,000 game rooms and all that type of stuff. You can just put in a little bit of effort into your marketing that everybody else is unwilling to do, and that's how you can rise to the top.
Nice, man. I love it. So let's talk about the asset, the house itself. So you're buying. You've already mentioned the where you're buying in tertiary markets. Is there a certain square footage that you're looking for? A certain
No,
bed
so
bath
I'll go back to
combination?
that question you asked me, right? So there's four things, right? But it starts with that marketability. If it doesn't have marketability in that first 60 to 90 seconds, I'm a Zillow guy because I think visually it's easier to look at Zillow on my phone and I never
Mm,
get onto a desktop. So
mm,
60, 90 seconds. If I can't find the marketability, immediately I move on. I don't care
mm,
how big it is. I don't care how many bedrooms, it has a pool, hot tub, whatever, because I don't get that separation and that's always outside, Gabe. It's nothing inside because you or your wife or your designer or whoever can come in and do hand painted murals and all the shit that we all do to make our properties look nicer, but it doesn't give me true separation. So that's
mm.
first. Then I'm doing the analysis. Then if I like the property, I find the market and I say, okay, what can I do from an ARV standpoint? I buy nothing turnkey ever. It's
Yeah,
all I always have to find ARV. How do I turn the $800,000 house into $1 million property? How
yeah.
do I turn the $395,000 property into a $600,000 property? And how
So
can I
are
take the
you
people?
also underwriting these as, I mean, you're not going to flip it, but you're also underwriting it essentially as a flip. So you're baking in your construction costs and then you want equity on the
100%.
back end.
Design costs, construction costs, travel costs to get it setup costs, everything goes into the pro forma, right? So I have a pro forma that I put everything into. And once I get to that stage, now I'm looking at number one is cash flow.
Yeah.
Number two is appreciation. So what I do is I go back and I look at a 5-year run rate of appreciation. So now that 2024 is done, I'm looking at 24, 23, 22. I skip 21, I skip 20, and then I go back to 19 and 18, and I average those together. Then for me, once again, that 2 extra steps, then I'm contacting the economic development departments in those cities. I'm going to planning and zoning and pulling, huge permits to see what's going on with mega development. And then I want to find out who's doing it, like Oracle here in Nashville right now, like the huge developments that are going on in Whitefish, Montana. That's why I've got $9 million invested into Whitefish and I'm making a $2.7 million offer right after this podcast because of that ancillary research about how that's going to affect appreciation and growth in these markets, right? Then I go to number 3, which for me is debt pay down. Almost every deal I do is 20%, 25%, and I try to do 20% AMs. If I can't, I'll do a 30-year amortization, and then I will accelerate down the payments out of profit, right? And then the last one's the tax benefits, and this is the one that I think where a lot of people fuck up. There's a great chef on Instagram. I don't know if you've ever seen him, and he wears a t-shirt that says, "Don't fuck it up." And he shows you how to make these 3 5-minute great meals, right? And that's what I don't want people to fuck it up, especially right now. And for those of you that are listening, if you don't keep track of what's going on with accelerated depreciation, it's already passed the House. It's in Congress right now. It's going to be out and it's going to be retroactive back to the day that President Trump was sworn in on January 20th. 100% accelerated depreciation. People are going to jump on that, especially high income earners. Oh my God, I got to go buy this $800,000 house to get a $150,000 tax break. You cannot let that tax tail wag the investment dog. You can't. It's just an ancillary benefit. That's why it's number 4. If you move that up to number 1, you're going to end up with a dog. You might get a $100,000 tax benefit in 2025, but then you're losing money in 24 and losing money in 23. You decide to sell, and then the IRS comes back and says, "Hey, Bill, you still owe me 2 years of that accelerated depreciation," and that's going to come out of your sales price, right? So it's those 4 cornerstones: cash flow, appreciation, um, debt pay down, and then also the tax benefits. And the debt pay down is super critical for me because I am a reposition guy. Even
Mm,
on single family homes, I am not a buy and hold long term. I want to get bigger, higher cash flowing, higher appreciating properties. That's why I have this system to where I start small, like the 395 condo,
mm.
right? And then within 5 years, I have 5 properties with only one upfront investment because I reposition at number 2 or 3. And if it's like in COVID, I'm splitting that. I'm appreciating so fast into 2 additional properties. Or now I'm doing it again. Like I'm selling a property right now, paid 788. I mean, selling it for 1.485, repositioning that into a $2.7 million property, right?
Yeah. I have always, that's something that I've struggled with a lot. I'm holding on to a number of like especially self storage facilities that I've already, I have a ton of equity in them and I've already done the work to reposition it. but so many people in real estate say hold it forever, never sell. But I've also, in my mind, you know, selling and then getting into a higher, better property makes more sense. And so I'm always debating, should I sell the properties that I've already done the work, I've already added the value and it's kind of maxed out, or should I just hold it for the long term? You're on more of the sell and then use that equity to put into a better property
Yeah,
side.
so I mean, and just in the short-term rental space, I've got $22 million worth of assets.
Wow.
I have $6 million of debt on those 22 million. So I've got $16 million in equity. And you want me to blow your mind, Gabe? This is 100% fucking truth.
Let's hear it.
$126,000 investment up front.
Wow, that's great.
That was in 2015. It's because of the way that I'm value stacking the equity. I
Yeah.
don't equity strip and hold on to the asset and devalue my cash flow. I don't want 50 or 100 properties.
Yeah.
I've only got 13. That's it.
Yep.
Right. So I used to buy $500,000, $600,000 properties when I started. Now I'm buying $2-3 million properties. And like, look at Whitefish, Montana as an example. I bought a property in July last year. I flipped it essentially. I had to, but and I couldn't get it permitted for STRs. Long story. I won't go into that. I thought I did all my research, blah, blah, blah. Um, and I paid 2.8 million was my basis on the acquisition. Got $150,000 seller credit. So 2.95, $150,000 seller credit. I sold it 7 months later for 3.4 million.
It's crazy.
So Whitefish, Montana is probably one of the fastest, most secure appreciation investable markets between 1.75 million and 5 million that you can find. Doesn't apply to like 600,000, 900,000. It's in this specific range where all the money's going, where all the development's happening, where people are looking to invest, right? And that's why I'm looking to invest into. I mean, I'm making a decision right now today between a $2.1 million beachfront Destin with private beach, which almost doesn't exist down there, huge marketability, 4-bedroom, 4-bath in Destin, and doesn't need a whole lot to upgrade. Or I'm spending 2.7 million on this place in Whitefish that has amazing views, like 4,000 square foot barn / event center is 7,000 square feet, but holy shit, it's going to take me 400K. It's Golden Girls, hasn't been touched since the Golden Girls was taken off the air, right? You know, when you see those built-in jet tubs and they have the orange knobs in them or they look tan because they're so old, I got to replace all that stuff. So the risk is bigger, excuse me, in Whitefish, but the return at 7.5% to 10% appreciation on that type of a property in that market versus I'm probably going to get your standard 3.5% to 4% on a $2 million property. Just that appreciation alone is a huge value separator.
That's crazy. Yeah, appreciation, especially in certain markets, it's just nuts. We were looking at a property here. We live in Tacoma, Washington, and we were looking at buying it, and we saw when the person purchased it recently, and we calculated that he was making almost $200,000 a year just from appreciation from the time he bought it to the time he sold it, which is just nuts. So
100%.
yeah, makes a lot of sense. Unfortunately, this is a short podcast. I really want to dive further into this, but I do need to move us on a little bit. Before we jump into the quick question round, though, I want to talk about hotels. You've invested in hotels. That's something that we don't hear a lot about on the show. It's not a common asset for your typical real estate investor to jump into. Tell us about the asset. Why did you choose to jump into it, and what do you like about it?
Yeah, so what I love about it is the reposition, as I mentioned
Mm,
earlier. It's tough for most people to reposition properties unless they're putting a lot of value add in afterwards. So
mm,
it's just how hotels transact. They're on a multiple of on a cap rate, right? Whereas a single family home, even if it's commercial, I'm using my
mm.
air quotes here, it's an Airbnb or a rental, it's always going to be sold based on a residential appraisal, at least for the
What is the
foreseeable
cap rate
future.
that hotels trade for?
I mean, it can be between 8 to 12 on a cap. It depends on where it is, the value. There's a lot of factors that go into factoring the cap
Yeah.
rate, but you can force the value add, force the appreciation through net operating income,
Hmm.
right? So we bought a hotel that's been dilapidated, run down. It's done about $500,000 at its height in COVID. We're putting in $350,000 to completely renovate the entire thing. We're bringing it to life. I typically can add 30 to 40% by default just in my marketing skills and my revenue management, my pricing skills. So we're forecasting that we'll do around $600,000 in revenue. If we do that for the first 24 months, we should be able to. We paid 1.49, I think, for it. We should be able to get a valuation of around 3 million. When we're only going to be in right around 2. Does that make sense?
Yeah,
So
that's
in this
awesome.
case, I started an investment fund with Kenny Bedwell, the founder of STR Insights, one of our main data tools in the along with their DNA in the short-term rental space. And he's an OG. He's been in my mastermind from the very beginning, and he's the number one property finder and data analyst in
Mm,
the industry. So it's a perfect fit for him and I, right? So we started the syndication. And the second part is we didn't use any of our own money for the very first time. I've been very apprehensive to do that. We just did
yeah.
this with like my mastermind, my inner circle programs that I've got students in, to see how it would go. And it's something that can create, specifically if somebody is the one that owns the syndication, if
Mm,
you can use other people's money. I know some people look at that as a bad terminology,
mm,
but if you can make sure you pay out, make sure you underwrite, you have a solid deal, then you can create yourself an infinite asset because you can reposition and repay back everybody, and then you own the entire asset.
yeah,
Even if we don't do that, just the ability to force value in cash flow and in the property value is really the thing about hotels and multifamily versus single family investments.
makes sense. What's the operating expense ratio that hotels run at? Is it probably pretty
I
high,
mean,
like
that's going to
60?
vary widely, but it should be around 40, 45%.
Really? Huh, that's lower than I expected.
I mean,
Um,
it could be up to 60, but I mean, for us, that's what we're shooting for is 40 to 45%.
huh,
I would say probably an average is going to be around 60. If you
mm,
go over 60, that's a red flag for me.
yeah, makes sense. All right, I do have to take that opportunity and push us into the quick question round. Are you ready?
Let's go. Yeah.
All right. It starts with education. It could be any form. It could be a conference you've gone to, a mentorship program you've been a part of, a book you've read, movie you've seen, anything. But I need two recommendations: one for general life wisdom, and then one for real estate.
Yeah, number 1, I believe, is The Pumpkin Plan by Mike Michalowicz. He's become a very good friend of mine. I've modeled my entire investing, strategy, my entire business strategy after what he teaches in The Pumpkin Plan. I would highly recommend that.
Hmm.
Number
Never heard
2,
that one. Pumpkin plan.
I think getting into a mastermind, I'm not going to say a specific one, can be an absolute life changing experience. Don't invest into the features and benefits you see in the program. That's where people make mistakes. Invest into the individual that is actually running that mastermind. I got into one right before I made this switch into SDRs. And at that time, I had to use 2 credit cards and make 4 payments to get into it. It was $100,000 a year, and it's the best of the best of marketers in the world. Even to this day, you would know every single person in that mastermind except for me and the other 2 people that pay to be in it. They're in it for free. And I've been in it and it's absolutely transcended my life. So get in a mastermind, but invest into the individual. Don't invest into what you see on the sales page.
There you go. All right. Next question is for your younger self. Let's go back to the Bill who was just getting started out, however many years ago. Go back to him, look him in the eye, give him one piece of advice moving forward.
Don't drop out of UCLA and get your education. No, that's not it. I
I
would
was
say
going to
that
say, you're the first person to say that.
I dropped out of UCLA after 3 months. I would say that I wish I would have stayed. At one time, I was very close friends with Tiger Woods. We grew up playing golf together in junior golf, and we were going to go to Stanford together. I just wasn't smart enough to be able to get in. Um, I would say that I wish I would have sustained the discipline and work ethic that I learned from him when I was 17 and he was literally 14 or maybe even 13 that his father instilled to him through the first half of my adult life that I did not. I have it today, but I did not have it then. And I'd probably still be a professional golfer, to be honest with you, if I would have instilled what I learned from him and his father.
Yeah, discipline is it doesn't matter what endeavor you're getting into, discipline is the ingredient you need. When you look at people like Tiger Woods, they have it in spades. So that's pretty cool that you got to play with him though, or grow up with him.
I
Um,
always lead off all of my speeches that I've slept with Tiger Woods over 100 times, and people are like, "What?"
all right, moving us on to the next question. This we've kind of touched on this before, but we're going to get a little bit deeper into it. We're talking about metros, places you like to invest. The United States, it's a big place. There's a lot of opportunity out there. Give me the single metro, the single city you're most excited about investing in today.
Whitefish, Montana, hands down. If I'm going to put a caveat onto that, an asterisk, only if you're financially secure. If you can make an investment without having to live off of the cash flow, it is an incredible place to invest. If you need the cash flow, go to Hot Springs, Arkansas.
That's funny. I used to own a self storage facility in Hot Springs, and it was one of my worst investments because I didn't realize that Hot Springs has one of the highest property crime rates in the nation.
Very
Um,
true.
and it definitely I experienced that, and so, but it does have great cash flow, so that's a positive.
So for us, it has 4 traffic drivers, right? You got the lake, you got the horse track, you got the hot baths, you got the casino. I mean, you've got pretty much everything you need. There's very few markets that have 4 traffic drivers,
Yeah,
and it's such a low barrier to entry from a cost standpoint.
they also have an alligator farm. I when I did my due diligence trip, I went around it, and it was it was like you would
Nice,
expect some security or some safety measures with an alligator farm, and it was very minimal. All that was
right?
separating you was this, like, waist high fence. I was like, this is Arkansas for you. All right, next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So, what's your favorite way to generate leads and find new deals?
I don't have to do that. So, I mean, it's not the same way as finding deals or wholesaling or anything like that in our world. You literally are going to vacation rental markets, staying out of urban areas, and seeing what is going to be unique, what you can ARV, and then you run the performas on them. Very few of our deals are being bought off market or sub two or through Crexy or any of that type of stuff because that's just not the quality that we're looking at, unfortunately.
Yeah,
So it's a little
makes
bit
sense.
different for us.
All right, next question is about lessons learned. Not every deal that we get into goes the way we expect it. In fact, many times things go a little bit sideways, but that's when we get to learn a lesson. So, what was a deal that went a little sideways for you? And then what was the lesson you pulled from it?
My number two short-term rental that I bought, I was literally at a winter classic hockey game, about 3 Mondo beers in, and a junior agent did a FaceTime walkthrough. I signed a contract between the second and third period, bought it sight unseen without contingencies. It was only $199,000. Long story short, got ripped away in a hurricane, ended up losing about $125,000. What I learned is get the fucking best of the best agent in your space, whether you're wholesaling or residential or short terming or whatever, in the market. Make sure you put your eyes on the property every single time. Don't ever buy a property. And then one of the big things for me is every property, and I invest all over the country, is I am there on the day of inspection personally to be with the inspector and also a contractor.
Yeah.
I will not move forward without that happening because you get inside information that inspector is not going to put onto the inspection report, whether it's a commercial property or residential property. And then I want to have my trusted contractor there walking behind the inspector so we can evaluate everything on what we're going to do as well. Makes it 100 times easier to evaluate the property and start setting a budget of what you're going to do to improve the property at the same time.
Yeah. And I actually I trust my contractors more than I trust inspectors. I have hired
Agreed.
inspectors, and they miss things, like
Mm.
even the house that we're in now. We just bought this house. It's a really old house. It's like over 100 years old, and there was the one of the main beams, that foundational beams, was rotting away, and the inspector did not catch it. After we purchased it, my contractor walked through and was like, "Hey, we need to replace that." And I'm like, "Son of a bitch."
Yep.
But that's just to say, inspectors, I just don't trust them. No offense, inspectors. Some of you guys are good, but anyways, moving us on to the last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you, and then what can they expect when they reach out?
The easiest place is Bill Faeth 73. That's Bill Faeth 73. That's my Instagram. DM me. Don't just say, "Hey, let's chat," or "Can we jump on a call?" Tell me what question you have, and I literally reply to all my own DMs. You can find me at billfaith.com, strwealth.com. I have the largest conference in our industry coming up in July, strwealthconference.com. Facebook group, Build STR Wealth with Bill Faeth. I've got 33,000 students in that free Facebook group. I'm pretty much everywhere. I'm on TikTok, Instagram, LinkedIn, any place as long as you spell my last name correctly with an E instead of an I.
There you go. I will put that link in the show notes. So if you guys want to reach out to Bill and get involved is in his universe, all you got to do is click a little more in the description. It's going to pull down that full description, and in there you can find his link. All right, Bill, that wraps it up. Thank you very much for hopping on the show.
Thanks for having me, Gabe. It was fun.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe, at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review. And if you guys want to get involved with our community, there should be a school link below. Go ahead and click on that. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.